Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. And I will begin, as I always do, by saying thank you. Thank you for taking time to listen, and thank you for your service. You don't hear it enough. You will always hear it here. The other thing you're always going to hear is the guru, Ed Zurndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at stwserve.com and we will help you any way we can. Those of you regular listeners know we like to follow Ed's FedZern articles to give you one more way that we can reach and teach. But wait, there's even one more, and that is the weekly serving. So every week we deliver the best of Ed, Jen Meyer, and Benefits Ben to your inbox. Don't miss it. See our subscription information on this YouTube page for the podcast. Boy, Ed, we had a big bill go through at the end of 2022, and a big part of that was the Secure Act 2.0. And while it's not quite as expansive as Secure 1, there's some meaningful changes in it, right?
Oh, very significant changes, and most of these changes will apply. I should say many of these changes will apply to the TSP. I'm so excited, Dan, about this. This is really going to be very good for federal employees regarding the TSP in many ways, and I'm so excited about this. And piece by piece, we're going to be explaining all the changes to the Fed zone.
Sure.
And I'm glad this is our first opportunity to talk about these changes. And I like to talk about as many as possible, how they're going to apply for federal employees and retirees.
Well, let's jump right in, because one of the big ones is that the age for required minimum distributions has been extended. So tell us about it.
Well, a little history lesson here. Secure Act 1.0, which was passed back in 2019, increased what's called the required beginning date. What is the required beginning date? The required beginning date is the deadline for an individual who is who has a qualified retirement plan, such as a 401k plan, such as a 403b plan, or the TSP, who has retired. The deadline to take his or her first required minimum distribution. And before the passage of Secure Act 1.0, what was the required beginning date? It was April 1st, following the year that the individual, this is the retirement plan participant or the traditional IRA owner, became age 70 and a half. Secure
Gotcha.
Act 1.0 increased the required beginning date to April 1st following the year for an individual who participant in a qualified retirement plan or a traditional IRA, to April 1st following the year they became age 72. Now, what that law, Secure Act 1.0 said was it's going to be for individuals, this increase in the required beginning date applicable to individuals born after June the 30th, 1949, which is myself. I was born in January 1951.
Sure.
So that was a welcome change. But Secure Act 2.0 says the following. The required beginning date is actually going to increase to age 75.
Ooh.
We're going to do it in phases. So effective January 1st, 2023, which was this past week, Qualified retirement plan participants who are retirees, including the TSP, and traditional IRA owners, their required beginning date will be April 1st, following the year that they become age 73. And for qualified retirement plan owners and traditional IRAs who were born after December 31st, 1950.
Mm-hmm.
Well, guess what, Dan? I was born in January 1951, so this applies to me.
There you go.
I don't have to take my first TSP RMD until April 1st, 2024. Before the passage of the Secure Act 2.0, as actually was signed into law on December 30th, 2022, I was all ready to take my first TSP RMD because I'm turning 72 this month.
Mm-hmm.
Don't have to. So that was a welcome change.
Sure.
And then finally, any qualified retirement plan participant who has retired, including TSP participants who were born, and traditional IRA owners who were born after December 31st, 1957,
Mm-hmm.
their required beginning date is April 1st, following the year they turn age 75.
Wow. Wow. I just missed that one. Nuts.
Just missed it.
Yep. Okay. And boy, your second one really, really, really speaks to me. Everybody knows that this is something that I'm big on. And that's that there's an expansion of qualified charitable distributions. So what's going on here?
Just as a review here, qualified charitable distributions, QCDs, have been around for a couple of years now. And what a QCD is, an individual who has a traditional IRA can make a charitable contribution from the IRA, and that charitable contribution, which is a distribution from their IRA, will not be included in income. Now, why is that useful? Because, as you know, Dan, when you are reach that required beginning date, you got to take an RMD from your IRA, from your IRA. And when you take your RMD from the traditional IRA, you have to pay tax on the money you're taking out. Now, the beauty of the QCD is you can use the QCD to fulfill your RMD requirement.
Gotcha.
You will not get a charitable donation. You won't be able to deduct that charitable contribution on your taxes, but you don't have to include that distribution that came from your IRA in income.
Sure.
It's really a win-win situation. Now, QCDs could only be made by individuals who are over age 70 and a half, and that's still the case.
And so they added something to this, though, involving charitable remainder trusts too, correct?
Well, starting this year, a one-time 50,000 QCD can be made to a charitable gift annuity, to a charitable remainder unit trust, or to a charitable remainder annuity trust. Dan, I know you will probably work for some people who, are wealthy, who like to make charitable contributions, and this is a great opportunity.
100%.
To transfer wealth, taking money out of their IRA and transferring it to a charity. It will ultimately cut down the amount of their RMDs later on, when they have to take RMDs from their IRA, whenever that happens. And also, currently, QCDs are limited to $100,000 per year. That's been the case from the get-go. But starting next year in 2024, that $100,000 limit will be indexed to inflation.
That's awesome. That is great. And we have some good news coming down the pike for IRA catch-up contributions, right?
Yeah. When it comes to IRAs, like the TSB, IRAs have catch-up contributions. For example, in 2022, because it's not too late to make a catch-up to contribute to your IRA for the year 2022. And I'm not just talking about traditional IRA, I'm talking about a Roth IRA, a traditional IRA. Those individuals who are at least age 50 can contribute an extra $1,000 to their IRA. Now, that $1,000 catch-up contribution, the catch-up contributions has been around, I believe, since 2001. It started off, I believe, at I think it was like $100, something very small, and it's increased very slowly. The reason it's increased very slowly is that it's only going to increase in a given year if the cost of living has resulted in at least a $500 increase. So obviously, the cost of living in any one given year hasn't gone up, to that extent. So they had to wait over a period of time in which the cumulative cost of living resulted in an increase amount of $1,000. Well, starting in 2024, the catch-up contribution will be indexed to inflation like the regular contributions, like the regular contributions. This year went from 22,500 up from 20,500 in the past year. So this is going to be a welcome change too.
Gotcha. And we've got something new called the Savers Match Program. What's that?
Oh yeah. I find that with some of my clients, because I have a tax practice, that I have some individuals who are single, some are married, but their income is not that much, and they're basically living from paycheck to paycheck. And they're many times the companies they work for do not have any type of retirement plan. So I say to them, "Have you thought about saving and putting money into an IRA?" I don't know. What is that? What is an IRA? It's an individual retirement account in which you can put money away for retirement. You're going to be saving for retirement. I mean, it's a good idea. Well, they say, I really don't know. Things are tight. Well, how much can I contribute to the IRA? I say, well, like I say, $6,000. That's a lot of money. You don't have to put the full $6,000 in. You could put in something less, maybe $2,000. Do I have to do it all at once? No, you do it over a period of time. But I will also tell you that IRS has something called the Savers Tax Credit. You'll get a tax credit for contributing to your IRA, assuming your income is below a certain level. What's a tax credit? It's a dollar for dollar reduction to your tax liability. But I don't think will have any tax liability. They take the taxes out, and I'm sure I'm not going to have to owe anything. Well, I got some good news for you. It's a refundable tax credit, meaning you're going to get that money. You're going to get that in the form of a refund, even though you don't have any liability. Oh, you've convinced me. Let's do it.
Sure.
I try to dress it up as much as possible. So
no, that's a sweet deal.
That is a good deal. The government is giving you money so that you're able to so that it's an incentive for you to save for retirement.
No, I like it.
It's almost the equivalent, Dan, of the earned income tax credit.
Sure.
Why did the federal government, start offering the earned income tax credit?
To incentivize people to work.
Exactly. And that's also a refundable tax credit.
Sure.
Well, now under Secure Act 2.0, we have something almost as good. It's called the Savers Match Program. It's going to start, I believe, in 2025. I'm sorry, 2027. And what is this all about? let me just go through the basics here. It's the purpose of the program. It's an incentive for individual retirement savings, in which the federal government will put in a matching contribution. The federal government is going to match your contribution up to $2,000. You put in $2,000 to that IRA, the federal government will put the same $2,000 into your IRA. Have you ever heard of such a thing? That's 100% match.
That's awesome.
And it makes no difference whether the individual has a tax liability. It's a refundable credit. Okay.
Sure.
Now whether the person will get this, can participate in this match program, depends on their income. Let me give you just an idea here what we're talking about here. Once again, the program's going to start on January 1st, 2027. If the individual files as married filing joint, their income has to be at least $41,000 and less than $71,000.
Okay.
If they file as single or married filing separate, their income has to be at least $20,500 and less than $35,500. And if they file as head of household, their AGI, their adjusted gross income, has to be between $30,750 and it has to be at least $30,750 and less than $53,250. I'm really excited about this.
Yeah, no, it looks awesome, Ed. The next one is pretty interesting too, and it involves 529 plans and Roth IRAs. What's going on there?
Wow, this is good. Then this one takes effect January 1st, 2024. But this is something exciting here. Dan, I know you probably have dealt with individuals putting money. They would like to set up a 529 college savings program. You've had some experience with that?
Correct. Yes.
Yeah. And the question always comes up, well, if I put all this money into the college savings plan and I'm doing it for my child, and let's say my child doesn't use up all the money, or maybe doesn't go to college, and here I have all this money that I set aside for this college savings program, this college savings plan, and my child didn't go to college, didn't use it all up, what happens then? Well,
Gotcha.
Maybe you have another child. You could pass on that money to that child. Well, then maybe that child doesn't want to go to college. And then what happens? Well, worst comes to worst, you can take the money out of the plan, okay? But you'll have to pay taxes on the earnings and a penalty, an early withdrawal penalty, okay? Now, with Secure Act 2.0, something great, to Secure 2.0 Act, something really good is going to happen, because you can take the person who contributed to that college saving plan, let's say the parent, can transfer up to $35,000 during their lifetime from that 529 college savings plan, in which the money was not used for college, to their own Roth.
Wow.
Okay. There are going to be certain rules and requirements to do that. For example, the college savings plan had to be open for at least 15 years. Okay. And they're going to be limited each year how much they can roll over from the 529 into their Roth IRA.
Sure.
But to me, this is a great opportunity for those people who have those college savings programs in which they have leftover money, to take that money and to roll it into the Roth IRA. And then eventually, if they want to take the money out of the Roth IRA, they won't have to pay tax on any of the earnings, no 10% early withdrawal penalty.
No, that's awesome. And so, Ed, that's for the owner or the beneficiary of the Roth?
That's for that's Roth. I mean, the owner of the Roth, the one who's rolling the money over, will be able to take the money out.
For the 529 plan, Is it for the owner of the 529 plan or the beneficiary of the 529 plan, or can either one of them do it?
No, it's only the owner, Dan. The owner,
Okay.
the one who funded the parent, let's say, who funded
Mhm.
that 529 plan.
Gotcha.
Only that person can do this rollover.
Gotcha. Okay. And I see there's some exceptions now to the 10% early distribution penalty that everybody is probably familiar with. You touch stuff before 59 and a half and you've got a penalty, but looks like there's some new exceptions.
Yes, under Secure 2.0 Act, one an individual who is living in a federal declared disaster areas and who has to take money out of their qualified retirement plan, and that includes the TSP, they can take out up to $22,000 of that plan and not be subject to a 10% early withdrawal penalty. Of course, they're going to have to pay tax, federal and state tax, if it, if it's a, let's say a traditional pre-tax qualified retirement plan. And that is actually effective. It goes back to January 26, 2021.
Mm-hmm.
Okay. Some of these exceptions, there's different effective dates.
Sure. Gotcha.
There's another one for if you have to take money out of your qualified retirement plan or TSP because you've been the victim of domestic abuse. Ouch. Hope that doesn't happen.
Sure.
You can take out up to $10,000, not be subject to a 10% withdrawal penalty. That takes effect January 1st, 2024. If you have a financial emergency, you could take up to $1,000 out, not be subject to a 10% penalty. That also takes effect January 1st, 2024. And the last one here is interesting. If you need to take money out of your qualified retirement plan to pay for long-term care, and I assume that includes paying your premiums, you can take up to $2,500.
Okay.
Okay. That becomes effective January 1st, 2025.
Gotcha. And this next, up next, this one's a biggie, and I know you're excited to get to this one. And this has to do with the expansion of the age 50 exception for our special provisions feds. So this is big news. Tell us about it.
Oh, this is exciting, Dan. We deal with federal special provision employees who include
Yes, we do.
Law enforcement officers and firefighters and air traffic controllers. They're under special rules. And back in 2014, Dan, Congress passed a law that allowed special employees who retire from federal service to start withdrawing from their traditional TSP at the age of 50, if they retire at age 50 or older. Normally, Dan, if you want to take money out of your traditional TSP, you can start taking money out of your traditional TSP and not be subject to a 10% early withdrawal penalty if you retire sometime during or after the year you turn 55.
Gotcha.
Well, special employees, according to this law in 2014, said that if they retire from federal service as a special provision employee at age 50 or older, they can withdraw from their traditional TSP and not be subject to a 10% early withdrawal penalty. Now, a special provision employee can retire at any age with 25 or more years of such service, a federal service.
Gotcha.
Or they can retire at age 50 with at least 20, they have between 20 and 25 years of service at age 50. Under the law that was passed in 2014, let's say a special provision employee retires at age 48 with 25 years of service.
Gotcha.
They could not start taking money out of their traditional TSP and not be subject to a 10% early withdrawal penalty. They would have had to wait to age 59 and a half. Why?
Gotcha.
Because they retired before they reached their 50th birthday.
Mm-hmm.
And I got the question, well, suppose they wait until age 50 then start taking money out of traditional TSP. Would they be subject to a 10% early withdrawal penalty? The answer is yes, they would be.
Mm.
Secure Act 2.0 says if a special, it's so-called a qualified public safety officer, which includes special provision employees.
Sure.
If they retire under these rules, they retire at age 20, at any age with 25 years of such service, or they retire at age 50 with between 20 and 25 years. Either way, they can take money out of their traditional TSP.
Nice.
And not be subject to a 10% early withdrawal penalty. Dan, this provision becomes effective January 1st, 2023. I hope we have some special provision employees who are listening. But in case they're not, this information is going to be published in the Fed Zone.
Absolutely.
ASAP.
Yep.
I'm going to put it out there.
Yep. We already have it in the works, Ed.
I am so excited about this, Dan.
Yeah, it should be. Absolutely. And I know we've got some fans in the federal firefighter community because they've shared a lot of our stuff. So if you happen to catch this one, make sure that you pass that along and be sure you can be pretty sure that this is stuff that we're going to be covering in our webinars too. So we'll be letting you know about that. All right. So up next, there's some enhancements to repayment of qualified birth or adoption expenses, time limitations, correct?
Yeah. Let's go back to.
Well, actually, that they're putting some restrictions there.
Yeah.
Correct.
That's correct, Dan. Let's go back to COVID.
Yeah.
Back in early 2020. When there were individuals who had to take money out of their TSP and IRAs for the case of a birth or an adoption, because things were not that good then at that time, and part of the CARES Act, and actually let me just say, the Secure Act, the Secure Act included a provision that allows individuals to receive penalty-free distributions from their qualified retirement accounts, including the TSP and IRAs, in case of a birth or an adoption. Gotcha. But Secure Act 1.0 said nothing about a time limitation for repaying those distributions.
Yep.
Okay. It was sort of like a loan with no payback period. Mm-hmm. Secure Act 2.0 imposes a 3-year time limit. Gotcha.
Now, our next two have a little bit in common in the fact that they deal with required minimum distributions. The first is that the penalty's coming down for if you miss. Tell us about that.
Yeah, everybody dreads that 50% penalty for missing one's RMD. It's been around from day one. Well, I think Congress realized that's a pretty hefty penalty. We got to reduce it.
Sure.
So effective immediately, it comes down to 25%.
Okay, that's better.
Well,
still heavy
incentive here to get it paid off, to get that RMD taken out, to take one's RMD earlier than later. That if one missed one's RMD in a particular year, like 2022, they'll have, if they take that RMD within 2 years. My example here, they missed their 2022 RMD. So they take their 2022 RMD no later then December 31st, 2024,
Mm-hmm.
the penalty will only be 10%.
That's even better.
Yeah.
And the other thing that's a change for RMDs is kind of cleaning up what can happen with Roth plans that are part of an employer plan like TSPs or 401ks. So there's no RMD requirements now for Roth TSP or Roth 401ks, correct?
Yeah, this is welcome news, Dan. I got to be honest with you, Dan. One of the things that's really bothered me about the TSP,
Mm-hmm.
and this is true for other qualified retirement plans, that if a retirement plan, such as the TSP, is offering both a traditional account, traditional TSP, and a Roth account, Roth TSP, and individuals contribute to both,
Mm-hmm.
and they retire, they reach that required beginning date in which they have to take an RMD, in this case the TSP. The
Gotcha.
TSP calculates the RMD for the retiree. And how's that RMD calculated? It's based on your account balance as of December 31st of the year that the RMD is being calculated for, and it's divided by, it's called a life expectancy factor. Let's back up here for a moment. Let's keep in mind that if one has contributed to the Roth TSP, the contributions they put in have already been taxed.
Mm-hmm.
The earnings they accrue will grow tax-free, provided that when the Roth TSP participant withdraws the money from the Roth TSP,
Mm-hmm.
it is what is called a qualified Roth TSP distribution, which that means that the Roth TSP participant is over 59 and a half, and it has been at least 5 years since January 1st of the year that the Roth TSP participant made his or her very first Roth TSP contribution.
Gotcha.
The Roth TSP has been around since 2012, Dan. If
Yes, it
somebody
has.
contributed to the Roth TSP, their very first contribution was made on February the 3rd, 2013. The 5-year meter starts as of January 1st, 2013. Go forward 5 years, January 1st, 2018. At that point, the money in the Roth TSP account is qualified.
Mm-hmm.
It's that simple.
Gotcha.
So the money coming out is tax-free.
Yes.
But here's the problem here, the TSP, as well as all other, until they change the law. When the TSP calculates that RMD, they're lumping together the traditional TSP balance. Everything coming out of the traditional TSP is going to be taxable. Everything coming out of the Roth TSP, assuming it's a qualified distribution, would be tax-free, but yet they're putting the two together. They're adding the two together, which resulting in a larger TSP RMD than necessary. It's increasing.
Absolutely.
This is not good.
I agree.
Is there a way around this? Well, if the Roth TSP participant rolls over, does a direct rollover or transfers their Roth TSP to a Roth IRA, which they can do when they retire. It's tax-free. You're going from apples to apples. Then there's going to be nothing in the Roth TSP account. So that won't be part of the TSP RMD. And that's what they should do.
Mm-hmm.
Here's where I'm crying my heart out. The TSP doesn't point that out in their publication. You
Very
don't
true.
know how many clients I've advised. You got to transfer that Roth TSP account to a Roth IRA. I thought I can't do that, they say. I earn too much money. That's not the case. There's no income limitations here as far as rollovers.
Correct.
By keeping that money in the Roth TSP, the result is it's going to increase your TSP R&D, meaning what? More income, more tax. Not only taxes you have to pay, you may have to pay more for Medicare Part B, which is based on your income. So
Nope.
finally, Congress did something about this. They're saying we're not going to include the retirement plans are not going to be including the Roth. The Roth account in the calculation of the RMD. Finally.
I agree with you, Ed. That's overdue.
This takes effect, by the way. It takes effect, by the way, Dan, on January 1st, 2024. Anybody who has retired from federal service who's reached his required beginning date for the 2023 TSP RMD will include their Roth TSP account as of whatever the account balance was on December 31st, 2022.
Gotcha. And our last two have a similar theme, and we're talking catch-up contributions. So the first one is supercharged retirement plan catch-up contributions that get started in 2025, correct?
That is correct, and that'll be for let's say federal employees who want to put additional catch-up contributions in their TSP, but it's only going to be for those federal employees who are age 60, 61, 62, or 63, and they can put up to $10,000 as catch-up contributions into the TSP.
Wow.
Those are called catch-up contributions.
So that's something we'll be adding to our TSP webinar for sure.
Oh, yes.
And then now here's a different wrinkle. And this is if you make over a certain amount of money, your age-based catch-up contribution might end up being Roth rather than traditional, correct?
Yeah. Secure Act 2.0 requires that depending on a qualified retirement plan or a TSP participant, because we're talking about the TSP here as well as any like a 401k plan. If we have a participant in these plans and their wages, in particular, Dan, here I'm talking about one's Social Security wages.
Mm-hmm.
Okay, one's Social Security wages. And if those wages are over a certain amount, then those individuals who are making catch-up contributions, those people over age 50, have to make those contributions, those catch-up contributions into the Roth account. They cannot put it into the traditional account. Now, this is going to take effect starting in 2024.
Mm-hmm.
And what the specifics are is that come 2024, if an individual's Social Security wages are $145,000 or more during 2024, and they're over age 50, their catch-up contributions, let's say to the TSP, have to go into the Roth TSP account. They cannot put any portion of their catch-up contribution into the traditional TSP. It has to go to the Roth account. And that $145,000 limit is going to be indexed to inflation over time.
No, gotcha.
Question. Go ahead, Dan.
No, go ahead.
I got to ask the question, why do you think Congress did that?
Because they have primarily higher income people taking advantage of it. So the tax deferral is coming out at a much higher rate, and this is going to bring more dollars in early. That would be my guess.
Exactly, Dan. Congress says, we want your money now. We want your tax dollars now. Now, if somebody's Social Security wages next year are below 145,000 and they're over 50, they can do whatever they want in terms of putting that catch-up contribution. They can put it into the traditional TSP, they can put it to Roth TSP, or a combination of both.
Gotcha. You know, Ed, I'm not mad at this because, you know, I've believed for, you know, a long time that one of the most powerful aspects of tax deferral is deferring for long periods of time. So the closer we get to retirement age, quite frankly, I've been having conversations with clients for years about, hey, how would you feel about doing your catch-ups in Roth? So I'm not mad at this. I don't see it as a negative. I know some people may take it that way, but folks, come on in and absolutely come to our webinars. We're gonna help you get your hands around this. Ed, don't know how you do it with all this stuff, but I'm glad you do it for us and on behalf of the federal community. Folks, that's a wrap. We are Serving as Served. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Please share it with friends and strangers. Check us out on Twitter and LinkedIn. Don't forget the live webinars every week at stwserve.com. Hit that blue button. It turns red. Click it. It'll take you to the menu. Sign up for one. Sign up for all. Share it with your friends. Be sure to read Ed every week in the Fed Zone. That's fed-zone.com. And don't forget to sign up for the weekly serving. Ed and all the rest of the Fed stars from Serving as Serve coming right to your inbox. So for Ed, the crew at Serving as Serve, and me, Dan Sipe, I will sign off as I always do by saying good luck, Godspeed, and above all, remember, it is your Fed life. So please make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.